What it do, fam? Been a minute since we talked about valuation, so today we're going to do a quick little thing to help investors both old and new find value in our market. You're watching securities, and this is a quick explainer on helpful ratios when screening stocks and looking for value. Now before we continue, we just like to remind you that this channel is meant for general education purposes only and isn't meant to replace the legal or financial advice from a paid professional. When it comes to investments, it's always healthy to take everything with a fair bit of skepticism regardless of the source, and that includes us. So for that reason, nothing we say here should be taken as a basis for investment, and you'll have to do your own work and thinking before deciding whether or not to take up a position on any stock that we mention here. Want to know how? Well, if you just scroll down a tiny bit, hit the like and subscribe buttons, we'll do our best to help you figure out how to figure out this game for yourself. And that being said, let's get to it. Alright, so we already talked to death about the basic ratios that most value investors look at to generate new ideas within a given market. The ratios that I'm referring to: price to earnings, or the ratio between a stock's price and the value of their net income on a per share basis. So, for example, if a company has 10 shares and makes 10,000 won in earnings, that's 1,000 won per share in earnings. If a share costs 2,000 won per share, then the PE ratio would be 2 to 1, often denoted as a full decimal number like 2.0, as you would be paying 2,000 won for 1,000 won of earnings. When checking PE ratios, it's always best to cross-reference a stock with its industry's average, but in general, the lower the better. Next, you have price to book ratio, which we also talk about quite a bit, which aims to tell you how much you're paying for the value of a company's tangible assets minus their liabilities at the current moment. Another way to think about it is to just consider how much you're paying for the total liquidation value of a company on a per share basis. If the ratio is under 1, then you're paying less money than the assets the company owns is actually worth. And if the company were to sell all of its assets and close up shop, you would earn rather than lose money from the sales. Next, if we look at the overall market trends over the past few years, we can see that we've been operating well above historical averages in price to earnings until the recent market adjustment, suggesting that we've been in a very bullish market over the majority of the pandemic. Still, these numbers are quite basic, so when screening for stocks, we like to throw a few more statistics in there. For example, you have the EV to EBITDA ratio, which we describe at length in this video in the right hand corner of your screen right now. This number can be most simply considered as a representation of the number of years it would take for a company's earnings to pay off an investment at the current price, should all things remain the same. Now, using the investing.com screener, which we will do in our second part to this video, they don't really give you the option to throw it in there, but it's something that we've talked about and is definitely worth your consideration. And if you have a Korean brokerage app, then it's likely listed in the stock stats section of any stock that you're looking for. Now today we're going to be talking about another statistic that we like to throw in to trim the fat and zero in on potentially undervalued companies trading at a discount. And what we're talking about today is the stock's price to free cash flow ratio. As with other statistics, price is best considered as the stock's market cap, or the total value of all of the shares on the market at the current market price. The free cash flow is a little bit more complicated, so let's focus on that for a hot second. Now, the equation for FCF can be broken down into a very intuitive and simple equation of cash flow from operations minus capital expenditures. To break this down further, cash flow from operations, often referred to as CFO, represents the total cash that a company can expect to make from their regular business activities. So, let's say you own a go-kart track in which there's only one go-kart that never breaks down. You charge manon per ride and expect 100 rides per 10-hour day. This means that your cash inflows from operations on the day would be about 1 million won. Now let's consider that you have to pay your staff 10,000 won per hour, spend 40,000 won on gas per day, and 10,000 won on lighting for the course for the day. That means that your operational expenditures, or OPEX, equals 150,000 won for that day. Doing all that simple math, we can see that our total CFO would be 150,000 won on the first day, right? That's what, 1 million won minus 150,000 won. Now let's say my guy is open 6 days a week. That makes it 5.1 million won per week, 20.4 million per month, and 244.8 million per year. Alright, cool. So we're sitting at a cold 244.8 million won in cash from operations, but remember that free cash flow also needs to subtract CapEx, and we're going to talk about that for a quick second. So the payment for things like gas, lights, and labor directly relate to the amount of cash that comes out of your revenues to finance the daily operations of the go-kart business. Thus, those expenses can be best considered as OPEX, right? Operation expenditures, right? Because you're using it to run your operations, and they're already factored into the CFO statistic. But what if you're not happy with this single go-kart situation? What if you want to expand your business? Well, that's where CapEx comes in. So what is CapEx? Simply put, capital expenditures account for usually one-time upfront payments on things that directly upgrade, acquire, or maintain equipment or physical assets of a business. So if our little go-kart guy wants to stay in business, he wants to make this one kart operation more appealing. To him, that means buying a new bunch of go-karts, of which he buys a fleet of 15 for 15 million won. He also spends money on land and a course expansion. This costs him another 135 million won for a total of 150 million won expended. Now let's assume that this all happens at the end of the year and he doesn't really make any money from it until next year. To identify the FCF, we could simply take the total 244.8 million earned from his one kart operation and subtract the 150 million spent for a total of 94.8 million won in free cash flow for the year. Now let's imagine that the stock's been sleeping for years. Nobody really has any interest in owning a small-scale go-kart company that somehow made it onto the stock market and stayed there. Who knows, maybe the company used to be larger, downsized due to financial issues, watched its stock plummet only to never recover, and for those reasons its market cap is at a measly 300 million won in market cap. Is this realistic? No, the company really is too small, but for the sake of this example, bear with me. Basic division gives us a price to FCF of 3.16, meaning that anyone buying into the stock would be paying roughly $3 for every $1 of loose cash. Given that this metric doesn't take in any other aspects of the company like potential growth, management, current book value, or aspects of the market like average price to free cash flow across an industry, it doesn't really tell us that much, but it does tell us that you're basically getting back 316 won for every 1,000 won that you put down, like immediately, because they have the cash. Now, how does this help us identify big steals? Well, think of it this way. With firms, cash is the lifeblood of a company, and free cash flow is all of the extra money that a company has that they can then use to pay out to investors, pay out to creditors, buy back stock, or use however they want. Thinking about it another way, if a price to FCF ratio is around 1, a value investor can think of that as an essentially free investment, since you'd basically be paying $1 of cash for a company that has that dollar in cash ready for you. This is all to say that the lower the price to FCF ratio is, the more likely the stock is to be undervalued or fairly valued. Naturally, the higher it is, the more likely it is to be overvalued, and identifying the future prospects of the stock is another thing, as well as determining whether or not the firm is actually a value trap. But this particular metric is a great way of thinning the herd while sifting through the thousands of stocks available out there on the open market. And that's the whole thing with stock screening. It doesn't answer all your questions, but it does help you focus in on a specific type of stock that you are looking to buy. Now, here is where I would usually use this metric to dig into a particular stock, but with the long weekend coming up, I think it's a good time for anyone new to this metric to just spend the next few days running stock screeners and seeing what they can come up with. We will, of course, dig into a few, but I'll save that for the next episode. Alright, that's it for me. It's another long weekend and we got another one coming up next week. I hope we all found this stat useful and that you do find this useful going forward. With the way the market has just dropped and a lot of anxiety all over the market with the whole Evergrande thing and the interest rates going up, I'm sure there are deals to be found. There are definitely some crates to be dug into. All it takes is a little elbow grease. And with that, be easy, fam. Peace.